Think you have to wait till 59 and a half to tap into your IRA without penalties? Well, think again. The IRS actually provides over a dozen exceptions that let you access your retirement funds early, penalty free, whether it's for education, medical expenses, or even buying your first home. There are legitimate ways to avoid that 10% early withdrawal penalty. So in this video, I'm going to walk through about 12 exceptions that where you can withdraw from your IRA and not pay that 10% penalty. First, I'm going to show you where this penalty shows up on your tax return, and let's see how you can avoid it. So here is a tax return, and this taxpayer, you can see here, they took a $10,000 IRA distribution. Okay, and this person is under 59 and a half. And since they didn't meet any of the exceptions on why they took out that $10,000, there's a 10% penalty. It's a 10% penalty tax on what the amount that you take out. So in this case, 10% of $10,000 is $1,000. So they got to pay that penalty tax. In this presentation, I'm going to walk through about 12 items that allows you to avoid having to pay this 10% penalty. Now, one thing to note is taking that withdrawal from your IRA doesn't, avoid paying tax on the amount that you took out. So in this case, they're still paying tax on this $10,000 because it's part of their overall adjusted gross income and taxable income, right? So you're not going to eliminate this component, but we are going to eliminate that 10% early withdrawal. So that's what I'm going to walk through. I just want to make sure it's clear on what this presentation is about and how all this works, because this gets kind of confusing pretty quickly. So again, you take money out of your IRA, you're under 59 and a half. If you don't meet one of the exceptions, you got to pay that 10% tax. Okay. And then that's on Schedule 2, Part 2, right? There's the 10%. In this presentation, I'm going to show you how to avoid that if you meet one of the exceptions, but you still might have to pay tax on that $10,000 you took out. All right, so let's go into the presentation. Okay, so we got a couple present slides that we're going to go through, and these are going to talk about exceptions to the penalty, meaning that if you're under 59 and a half, when you take the money out, you don't pay that 10% penalty. So the first one is distribution made or on after the date you turn 59 and a half. So this is an obvious one, right? You've reached that age, you take money out, there's no 10% penalty. Next up, death or disability. So distribution is made to a beneficiary, yourself or estate, after the account holder's death are exempt. Distributions made due to the account holder's disability. So you're disabled, you can't do anything because you're disabled, you can take money out and you don't have to pay that 10% penalty. Substantial equal period payments. This is very complex. This could be a presentation on its own, but essentially you take distributions out. They have to be the same amount and they got to be continual for at least 5 years or until the account holder reaches the age 59 and a half. So this one's, again, complex. I may create a separate presentation on this item. Unreimbursed medical expenses. So distributions used to pay unreimbursed medical expenses that exceed 7.5% of your AGI. So first you got to take your AGI, just say it's $100,000, and you multiply it by 7.5%, right? So in that case, it's $7,500. If your medical expenses are beyond that, you can take money out to help pay for that. But if it's below that amount, then you can't take it without that 10% penalty. Next up, health insurance premiums for the unemployed, right? So you're unemployed and you need to pay for health insurance. You can withdraw money from your IRA and not pay 10%. But there are some rules to follow here. So you received unemployment compensation for at least 12 consecutive weeks. The distribution from your IRA is made within the year of unemployment compensation, meaning that you can't just be unemployed, wait 2 years, and then kind of take this. And the distribution is made no later than 60 days after reemployment, right? So, and unemployed, then you got a new job, and then 61 days go after and you decide to kind of dip in your IRA. You can't do that. All right, some more here. Qualified higher education expenses. So you're getting your MBA, your master's, you want to take money out, you can do that without paying the penalty. Those fees or the amounts that you've taken out are used for these expenses. First time home purchase, right? Distributions up to $10,000. So you can't take $100,000. You're limited to $10,000 buy your first home, and you must not have owned a principal residence in the previous 2 years, and the funds must be used within 120 days after you've taken them out of your IRA account. Again, this is avoid that 10% penalty. I just want to keep that reminder out there. Higher education expenses, first time home purchase. All right. So qualified birth or adoption distribution, right? So distributions up to $5,000 per child per parent made within 1 year of the birth or legal adoption of a child. Qualified reservist distributions. So if you're part of the National Guard or military and you're called on active duty, you're allowed to kind of withdraw from your IRA and avoid those penalties. IRS levy, right? So you get those IRS letters and they say they're going to put a levy on you until you make this payment. You can withdraw money from your IRA, make that payment to the IRS. Emergency personal expenses. So you're allowed up to $1,000 per year for emergency personal expenses. And then corrective distributions. So we see this a lot, unfortunately, where people contribute more to an IRA than they're supposed to. So they got to make a distribution so they don't exceed that max contribution. So that distribution that they take out that to repay themselves is not subject to that penalty. And then disaster recovery distribution. So you're in a disaster zone, your home is damaged, or you're building a home, it's been damaged. You can take up to $20,000 per disaster and not incur that 10% penalty. And the distributions to terminally ill individuals, distributions made to an individual certified by a physician as having an illness or physical condition expected to result in death within 84 months. You can take money out and not pay that penalty. So I think the key in all this is to understand when you take that money out that you don't have to pay tax on any of it. But then you also, when you take that money out, and if you're doing your own tax return, you got to make sure that you code it correctly to avoid that 10%.